Hello and welcome to Moneycontrol. The markets are trading range-bound to positive post strong selling pressure observed in yesterday's trading session. Nifty is trading around 21,700 while Bank Nifty is trading around 45,300. A major challenge that all traders are currently facing is managing volatility in the current market scenario. As we know, India VIX has now surpassed 16 levels and is trading around a 6-month high from the lows of 10 in September. Our discussion today revolves around managing trades in highly volatile markets. Joining us to take this conversation forward are market experts Rajesh Sriwastava, derivatives trader, Rohit Srivastava, founder of Strike Money and Indiacharts, and Sudeep Shah, head of derivative and technical research at SBI Securities. Gentlemen, welcome to the show. I would like to start with hearing your views on the markets and the current volatility that is being observed and whether you see that the market has found its top. Starting with Rohit, if you could start.
Yeah, my sense is that the high that we made in January, which was again retested in February, which is around 22,127, is probably a top for a while. We have started to witness a correction, both in stocks and sectors, which typically lasts at least for 1 to 3 months, because seasonally Jan to March tends to be a weak period for the market. And during this phase, then you typically see a lot of volatility, bouts of buying and selling going on. And that is the first thing to be, aware of. We have seen a substantial rise also in certain stocks. So you have to be prepared for meaningful retracements as and where they happen. And so it may not be easy to trade because people have gotten pretty much used to, being long only. So what we do anticipate is possibly a short-term bounce, but it may not last very far. I don't think we will go much above 21,800, and possibly you start seeing selling again from there. Eventually, we may head sub 21,000, maybe to even 20,300 or 20,200 in the weeks ahead.
So you are predicting that markets won't cross the psychological mark of 22,000?
No, not immediately, at least. I don't think that's an immediate case for it to happen. I think the correction that has started is likely to last for a while. We will, of course, rework on the possibility that, this could end up be a slightly more lasting top for a while. But at least for now, for the next 2 months, I don't think we are going to cross it.
Interesting. Sudeep, how do you see the markets? Anything that you would like to add to this?
Seeing in the market is that post this top being formed or 22,100 levels, partially in the last several weeks, we have seen markets trading in this range of 21,300 and 22,000 on the upside. Almost 6 to 7 weeks we have witnessed this trade happening in this range. But what I feel is that still we definitely cannot call this as a top. I differ in my view here. And also, what important thing, what we are seeing is that last 3 times, December, Jan and February, whenever there was this sudden sharp correction that we have witnessed, there was always on the second day there was a bounce back that was witnessed. But in both the previous cases, on the second day itself, the 10 as well as the 20-day exponential moving average was recaptured. Only in this, we need to see today how the trade pans out for the remaining of the session, and in the next few days whether this 10 as well as 20-day exponential moving average, which is the shortest moving average, is recaptured. Definitely there is some cool off from higher levels that is witnessed, and from an extreme short-term perspective, I feel that 21,500 levels, 21,450 zone will be an extremely important level to watch. We feel that the markets could consolidate around this 21,500, 21,800 mark, and focus could be returning back on large caps, as from here on volatility could be on a gradual up move ahead of the general elections. Also, sectoral rotation could be witnessed in favor of IT, pharma, oil and gas, auto. All these 4 spaces could witness some incremental momentum on the upside, while FMCG, financials as well as metals could remain under pressure. So what we feel is that remaining stock and sector specific would be the key from here on.
Deep is positive on the markets. Rohit seems to be thinking that we have found some top. Rajesh, what do you feel about the markets?
I have very similar view like Sudeep. I don't think we are, yet to call out a top, because yesterday, if you see on a headline level, yeah, we had some not some great number on Bank Nifty 1,000 point fall, but then that's largely because of HDFC Bank. I mean, 1% of HDFC Bank is adding about 195 points. So on the headline level, yes, there was a nasty number, but then there was a sell-off in the broader market. But then when we look into the fine prints of those sell-off, not much volume were there. Like if you see the previous 3 days of rise in the broader market, the volumes were almost half of those previous 3 days. So yeah, a sell-off without a sizable volume is just kind of, you can say, a shakeout or a margin call by someone would have been triggered. Does not look like a distribution kind of started yet. But to be cautious, we have to currently restrict the new purchases and manage the old trade with if it is investment, and with a stop loss if needed. If not, then hedge with some other instrument on the index level. So yeah, we are not yet calling it a top yet.
So let's now try to understand volatility. See, despite the advantage that volatility presents, which is more opportunities for making profits, usually heightened volatility comes with a lack of directional certainty, making it difficult for traders to take aggressive one-sided bets. So for all the viewers out there, I would like to ask you all, as traders, how do you all tackle such kind of volatility? Starting with Rajesh ji, if you could start.
So a particularly if we're talking about the option traders, they would love this volatility because they've been asking for this volatility for a long time. So it is here, but then it's kind of a random volatility, directionless volatility rather, I would say. And it is posing some challenge, but then if it is option trading, you can just make some fine tune to your strategies and you can still survive that volatility. And this volatility was almost anticipated. We were heading up to a national election, general assembly election. So it's not that something we are not anticipating this volatility. It was very much in line with the anticipation. Now, how do we manage this? For broader market, if you don't want to be in a hot water, ideally you should restrict your what is the level up to which you can hold a position and then exit and sit out till the events are out or till the short-term volatility is out. And for a derivative trader, they need this because see just a couple of months back we were at weeks of 11 and 12, and if you are doing straddle and strangle, hardly you were getting 250 rupees, 300 rupees. Now it is, on the Bank Nifty. Now it is a much better price on the option front to trade, and then this is something option trader were asking for. So now they got it.
So you suggest like exiting in case of your trades go wrong. Rohit, how would you suggest for viewers to tackle volatility when trades go wrong? How do you do you hedge? Do you take an exit position? How do you tackle such kind of volatility?
Hedging, I don't think is really an approach because you have to get your entire approach towards trading right, from the beginning. Before you get to the point where you're wrong, which simply means that have you created an allocation? How much of your capital are you going to really trade with? So I would typically say allocate a percentage, like let's say 20% of your portfolio towards trading is what I do. Everyone can have a different allocation, but knowing that number is important. Therefore, you know how much you're really risking at that particular point of time. Now, once you've decided on that risk, there are a couple of approaches that you'd need to take, and one of them that we really push hard is position sizing. Now, what position sizing really means is that if you really want to buy 1,000 shares or you want to short 1,000 shares, you don't do it all at once. You do it in phases, which means that you start with maybe 20%, and then you add on to that as and when you get confirmation. And confirmation means it can come from Dow theory, the very simplest higher highs, higher lows, or lower highs, lower lows. You could use a moving average or you could use a momentum indicator. Now, we do use our own, momentum indicator known as the RMI or the Rohit momentum indicator. Essentially, it tries to be a little faster than the MACD or the ROC and a little smoother so that you can get quick signals in and out of the market. Now, specific to volatility, so once you've actually built a position, what you see here on the screen is something known as the momentum swing. So what we do is we measure the entire basket of FNO stocks and look at whether they are all rising in momentum or falling in momentum. And this sort of gives us some very short-term turning points in the market where you can actually reduce your longs or reduce your shorts. And by doing that, you actually end up managing risk of being exposed to losing too much. So, for example, if you look at on the 23rd of January, there was a reading which was almost at 16%, which means that 16% of these stocks were really showing positive momentum, which means most of the stocks were showing negative momentum. And that's sort of a near oversold condition from where we started to bounce back. And then subsequently, we've seen that reading go well above 80%. And from there, the market's been sort of slowly rolling over. So these kind of, very extreme readings, when you get them, we can actually sense that, okay, this may be a time to cover or pull back. Right now, for example, yesterday, we are seeing a reading of 25. So it's still not oversold. If you get another day or two of selling, then probably you'll be at a point where you tell traders that, you cut back your positions, you might get a 2-3 day bounce. So using this kind of a quick swing indicator actually helps us in dealing with the near-term points, volatility that happens every 2-3 days. The market is turning from one side to the other, and we can actually capture that. We can also do this using something like the momentum indicator, say on the Nifty hourly chart. So we actually end up pulling together a setup where the RMI, which I was speaking of, if I actually go to an hourly chart for very short-term traders. But I also recommend that people don't use only one time frame. So, for example, if you're a short-term trader, you'd want to use 2 time frames. You'd want to use the daily chart and the hourly chart in combination, which will sort of help you trade the 4-5 day kind of time horizon, which simply means that if your daily chart is giving a buy signal, okay, and you can actually see the signals of the indicator either on the chart itself, where the red line crosses the green line, or you can actually see it visually on the left-hand side in the table. And once you see a signal on the daily time frame, you want to trade that direction on the hourly time frame. So what it basically means is that if the larger trend is up, you want to essentially go long, then you want to exit, you want to go long, you want to exit. You don't want to trade against the trend, because what happens with counter trend trades is more often than not, they don't give you much returns, and then you get stopped out. So it creates an unnecessary loss. So the idea should always be to trade in the direction of the main trend, which is determined by a higher degree. So when we combine a daily and hourly, we are seeing that the daily chart then determines our trend in terms of which direction you want to trade, which currently is in a bullish mode. So if I simply go to the daily chart, you see that in a bearish mode, that the RMI actually crossed over to the sell side yesterday. But when we go to the hourly chart, what we'll end up seeing is that it's actually giving a bullish crossover this morning. So what that tells us is that we don't have another short trade, even though the daily chart is saying we are in sell mode, and we simply need to wait for the RMI to essentially move up, possibly well above the zero line. That's when we actually look for the next trade and then give another sell signal. So when this red line crosses over here and gives us another sell signal, that is when we would look at, building another short to the downside. So this is how we'll combine, 2 time frames along with, our momentum indicator to actually tell you when to, really be long or be short. And that's sort of the approach I think all the traders need to really take, wherein they can combine 2 time frames, because a single time frame can lead to bad trades. And then use sentiment indicators, like I showed you swing. We can also have other sentiment indicators, like you can look at extremes in positioning. For example, our FII is long or short at this particular point of time. So when we go into the peak of January, what we end up seeing is that this was the 3rd time in a period of time where FIIs had an extreme long position at the top end of the range, which is more than 1 lakh contracts. This is the 2nd time it happened was in July, and the 3rd time it happened up here in January. So December to Jan, when they were extremely long, we are essentially looking at the market turning from up to down, and that is where we become careful, reduce our positions, and start looking at building trades on the short side as well. Now, when would we look at buying again from this perspective? You would essentially wait for the data point to get extremely oversold, as it does at the bottom end, which means that if FIs were actually short more than, say, 150, 170,000 contracts, then we would be getting somewhere closer to the oversold zone based on what has happened the last 2 times. So this is sentiment, which is positioning. very short-term sentiment I explained to you on the swing. And then you have the momentum indicator, and you combine all of this, I think, and you can sort of deal with a lot of volatility in the market. That is sort of the approach that we take.
So sentiment and momentum indicators are what you suggest to tackle volatility. Coming back to Sudeep. Sudeep, what kind of data points are you looking at when you're tracking volatility and seeing where markets are headed next?
Yeah. So, see, what we feel is that, rightly said by Rohit, that we need to have multi-time frame analysis. Traders should, in fact, check the overall trend initially on a medium-term chart and then go on a smaller time frame. And the time frame will depend on a trader to trader. If someone is a swing trader or someone is an intraday trader, the time frame would be as lower as 15 minutes, or for a swing trader, it could be hourly chart. So the time frame would keep on differing with respect to every trader. And also one needs to have a sense of what sectors are outperforming and which are underperforming, and where the key large caps are placed. Now, see, apart from all these open interest data that we study, what is important is that we need to have a sense of where the markets are heading. And how would you get that sense? So now, if you see with Reliance and IT showing strength, we have seen buying emerge at lower levels in Nifty in the last few days. And with HDFC Bank not performing, the Bank Nifty was underperforming. So we know that on a Nifty, there is always a buy on dip trade, and in Bank Nifty, there is always a sell on rise trade. So understanding what trades are emerging in which index is very important. And hence it is very crucial that we have a close eye on the index components and the way they are trading, apart from having a eye on the main indices. And along with this, the traders should study the open interest positioning that would help them to form a trading range to start with. Intraday addition or unwinding of open interest in the at the money options would give traders a cue on the direction of the index. And along with that, there are a couple of important indicators that the traders should be studying. That is, the first one is the put call ratio, to have a sense on the strength of a particular trend. So if the PCR, the put call ratio, is above 1 or it is strengthening, then we definitely could assert that the put writers are far more stronger than the call writers, and markets would witness buying on all dips. But if the PCR, if the put call ratio is weaker, then that would mean that the call writers are quite dominating here, and the markets would witness, say, sell on rise, it would be in a sell on rise mode. Apart from this, FII's positioning in the index futures and options plays a very important role. Now, we regularly keep discussing about the FII long-short ratio. And you see, since the beginning of the series, FII's long-short ratio has not crossed 40%, and it has been oscillating between 25 and 40%. And a ratio of lower than 50-55 will always means that the bears would dominate. And here also, although indices are in a range, in a 600-point wide range, 21,400, 500 on the downside and 22,000 on the upside, but every time the markets have witnessed either a gap up opening or the markets have approached 21,900, 22,000 thereabouts, we have witnessed selling pressure from higher levels, which implies that the bears are still dominating. So I feel all these indicators in totality will help a trader to manage the volatility in options, and only one or two indicators particularly will not help if someone is just tracking one indicator or two indicators. One needs to have a sense of this entire discussion that we have just had on index options for him or her to be a successful option trader.
Right. But for a swing trader, like, let's talk about this week, how you're seeing, because PSUs, like you mentioned, the banking sector is a sell on rise, while the Nifty is showing a buy on dips. So what led to the PSU, if you talk about the volatility in the PSU sector yesterday, and going forward for a swing trader, you mentioned like some technical indicators, but what would be the difference between intraday? Like, should one take an intraday bet in a volatile market, or should one go for swing trading? That's the question that I'll put up. Any one of y'all can take this.
See, on a derivative front, the kind of market we have, it is strongly suggested to have an intraday trade. I mean, you can open tomorrow morning 200 point up, or even in a single day market, it can form M or W pattern. So ideally to deal with this, keep your trades intraday and the derivative, and non-derivative, you can play some swing trades, okay? Because there you don't have to really pay M to M every single day or kind of. So that's the one. But then I was just listening to Sudeep ji, and then Sudeep mentioned the point of sectoral indices. And while he was talking, I just run through some data, and then out of 23 sectors which are actively traded, about 14 sectors are still having a better outperformance, in terms of data against Nifty. So in case anybody looking to deal with this volatility or have some bets already on the place, so one can look into the stronger one to go long and the weaker one to go short. Like usually we go with the trend, but then this trend is, if you see today itself, like we were down 50, 60 and then up 100 and then now again down into red. So this kind of long short long will help our trades at this point of time.
So what kind of so I want to understand from you, like, how do you understand how our is market heavy, and how do you identify stocks in a volatile market?
How do we enter stock in the volatile market? So I basically go and look where are the positions are built, and in terms of even larger positions are built in the line of call or the puts, and then accordingly I try to pick up my trades. See, yesterday also when the things were not very good for a broader market, there were constant call selling in many of the counters, and then even though there was green for a small period of time today, those counters were showing sign of weakness. So I go and look out for the build-ups where the market has positioned itself, and it's not like 100 or 200 lots of position, like at least minimum 1,000 lots of position should be there in the place, and then we pick up our trades out of that.
Rohit, how do you identify stocks in like a volatile market?
Good talking.
Is this for me?
Rohit, how do you identify stocks in a volatile market?
Okay.
Rohit, and then Sudeep can take over.
Sure. So my approach is really to look at relative strength in the market across stocks and a basket based on what the market is doing. Say, for example, if we see that the market has been going up or makes a higher top than it has made before, and if we are thinking that, well, the market's gone far ahead and we want to look at the sell side, then what I'd really look for is which are the weakest segments during that advance, over that period of time. Like, say, for example, the market topped out around the 15th of January. It sold off, and then again it made a new high all the way into the 7th of Feb. So say between the 15th of Jan and 7th of February, if I simply look at something which is a customized heat map. So if I actually look at performance of these stocks between 15th and 7th, and I look at which are the worst performing stocks, and I can do that in stocks and sectors, so I can do that for both. Okay, and I can look at any particular segment. So for example, and I look at which is the worst performing. So if the worst performing here is, say, BEL, for example, that becomes the candidate for you to actually look at sell side during that phase in the market. So for example, I could have chosen any lot, any particular index where I see negative performance. So say, for example, there's APL Apollo, right here, which is actually down 11% during that period. Then that becomes a better candidate on the sell side. Now, of course, not all of these are in FNO. So I could do the same exercise simply looking at FNO stocks. If you want to trade the sell side, you would simply go to stocks between the 15th of January and the 7th of February, which is the two peaks that we made in the market, and then look at which are the bottom performers. So actually you get this entire list. So what I would look at shorting then at that point of time would be something within this. Of course, the next filtration is, okay, what is their setup? So I'll have to actually open each of the charts and look at where the risk reward is favorable. But this sort of gives me the starting point as to which are the stocks that I will look at, and the worst performing ones, which are like AU Bank, UPL, and so on. This would become the place where we would actually then look for opportunities.
Next week, what are you seeing for next week or this month ahead for February? How are you seeing? Which can you identify are a good pick? Rohit.
You're asking me? Okay.
Yeah.
So I think, see, to me, so to me right now, if I go by weakness in particular segments, they're pretty much widespread here. It's not just banking. We see media also another place where there has been meaningful weakness. Okay, there's also been the FMCG sector which has been weak. So those then become the immediate easy targets because the slightest dip in the market causes those stocks to fall. So if you want to look for high probability easy targets where the risk of loss is less, then that is what I would go to. I'll not name any specific stocks because we can't really advise people there, but those are the broad sectors. If you just look at all the red and you can see which are the sectors showing up among these red stocks, then that sort of gives you an idea.
All right, and we'll go to Rajesh and Sudeep. Rajesh, where do you see, like, in the next week or the February series, what kind of sectors will outperform, which sectors are not gonna make it, and in this volatility, where do you put your bets?
Well, go ahead, Sudeep.
Sudeep.
Yeah. So, see, I feel that post this corrective move in the last few days, 21,450, 21,500 on an index level should hold. And as I said earlier, that there could be some consolidation. So I feel that IT index, which is not, see, it has, in a way, it has held out. It has stemmed the entire fall in case of Nifty. But if you see the large cap IT names such as, say, TCS, HCL Tech, they are showing some kind of positive chart formation. So I feel that IT stocks could continue to head higher. Even pharma stocks look good. Oil and gas stocks are also showing strength. So I feel these pockets, IT, pharma, oil and gas, auto, they look really strong from here on, and they could nullify what could be potential weakness in FMCG, financial stocks, and even selective metal names which are under pressure. So I feel overall it would be a consolidation that we would be witnessing in the next 4 to 6 sessions. And 21,400, 21,450 on the downside, as well as 22,000 on the upside, could be the range for the markets that the Nifty would be trading into in the next 4 to 6 sessions.
Rajesh, same question for you, but I would also like to add one more question. As we could see that volatility before, option buying was being preferred, because when in September markets were seeing low volatility and option buying, people were making more money and option writers were struggling. Now as we have gone on to 16 levels, or we're predicting 17 to be touched, do you feel that option writers are now as profitable as they used to be a few years ago at this kind of volatility levels? And just to add on to the same question of stocks, what kind of stocks or sectors are you going to see push through this volatile market?
First on the stocks, yes. So oil and gas, pharma, IT, and if you go by the normal negative correlation between IT and the banks, they have negative correlations. So the way banks are performing, I mean, in fact, banks have like underperformed to a large extent. So IT is one sector where one can bet on a longer side, and of course oil and gas. I'm just looking at data, and then there's no sort of any weakness into the oil and gas counters. So
some names, sir, some names that you could like push out. Is what your data is showing.
So Reliance in case of pharma, and in case of hospitals, Medanta, Apollo, and in fact I saw one more yesterday. So a lot of hospitals are having a lot of nice positions built yesterday. Even during the fall, I mean, there were a lot of buying with the volume. So not only pharma, you can look into the hospital stock as well. So if you ask me the strongest sector at this point of time, oil and gas, and then when it comes to oil and gas, nothing comes in close to Reliance. So oil and gas, pharma, and IT, just because I mean, if you see Nasdaq is also doing good, and it has a negative correlation historically proven. So I mean, if you have to take a long bet, you can still go with this. Coming to option traders, yes, I mean, they are better off than what used to be November or December. Of course, some sort of volatility is troubling, and up down kind of random volatility, but they have more bandwidth to manage their trade compared to 6 months back. I mean, not even 6 months, like just 4 months, 3 months back. I mean, you have to adjust your trade quite often during the day, and then hardly you had anything on the table to make money. Now we have a lot of money. If once things get settled and then intense move like 50 point in 2 candles or 5-minute stops, the option trader will have better time than what they struggle on the last 4-5 months.
So when do you anticipate this volatility to cool down, especially as elections are coming? When is your anticipated bet that volatility will cool off, or how do you see volatility in the next for 2 to 3 months? Rohit.
Yeah.
Rajesh ji, continue.
Yeah, I mean, I don't see this volatility is going to cool off in the next 3 months till the election comes in. Okay, so possibly the day of result or day before the result will have the highest level of the VIX, which is now we have seen in the last 1 year or 2 years. Okay, so volatility is not going to calm down in near time, but then yes, we have to find our bets among these volatile moves. So it's not going to come down in near time.
Rohit, what's your view? And should one do an option buying or option writing? I know option writing comes with a larger margin to give, but what is the better way to go about this?
Personally, I'm mostly an options buyer, so I either trade naked long calls or long puts. But the question here is what happens between now and the election. So my sense is like this. Between now and March, like I mentioned earlier, the seasonal bearish period remains. And so we would be more put buyers between now and March. And then I think usually if we just look at what happened even in 2019, there was a correction in the same period. And post-April, because that's when, that's like from the end of March into April, that's when the election mania really kicks in. And that's where you saw the last rally as well, in the previous elections, 2019. We saw the market rally all the way into the month of May and then only cool off after that. So I can try and anticipate something similar, that initially we do see this sell-off, which is happening right now, which is cooling off the one-sided rally that we have seen. And once the correction is done, then we may start what is our election rally from late March, early April, all the way into May.
Sudeep, what's your view?
I also have a similar view because see, even in the 2019 election period, from the February to May time frame, we had seen volatility index spiking from 14 to 30 levels, and immediately post the result announcements, we had seen a drastic cool off in the VIX from higher levels back to 15, 16 levels. So I feel overall, starting here, the volatility would keep on gradually rising higher. But and I agree with Rohit that post March end or going into April, we could see the markets showing some kind of a positive momentum, and it could be a broad-based rally, not only confined to a few sectors that we had even in 2019. If you see prior to the election month or prior to the election results, in that last April to May period, it was a broad-based rally, and that time also it was not confined to a few pockets. So I see a similar move happening, and yes, so post the election there could be a cool off in the volatility.
Okay, so I'm going to ask some simpler questions. Rohit, if you could answer this, what would be some steps that to construct like a simple, successful trading portfolio?
Well, I can't recommend particular stocks, but if I just think of the Nifty, I think between now and March, buying at the money or slightly out of the money puts would be my strategy. Anywhere between 21,500 to 21,100. If you're going into March, then even 21,000. Those would be good strikes to really look at put buying. And that would be till the end of March. Once that is done, then from there on, depending on what level we reach over there, we'll take a similar strategy of looking at, call options. The only difference being that the premiums are going to shoot up a lot in April, which is what always happens, just like was mentioned earlier, that the VIX actually shoots up. They'll go to 30% or so because of the anticipated election result. The problem with that is that the payoff is really not that great. So we may not go very aggressive on the option side into an election rally. It probably make more sense to be in the futures market, because at least you'll get directional gains. Or you may be in the cash market. The option side might not make so much sense, given the premiums will shoot up. And when they fall
Payoff
after
not
the election
great.
results, you sort of give up your gains.
Why? Just to add, why would the payoff not be great? Can you explain that in a little more detail?
Yeah, so when the premium shoots to 30%, you'll pay 2 times or 3 times what you would have usually done for a call option. And even if you get a 5-6% move in the market on that one day, you may not gain that much, because one, there is time between the event and when you're buying. And second is, immediately after the event, when you think you're going to get those gains, the market goes up 7% and the volatility VIX drops from 30 to 14. And that sort of kills all the gains that you're going to get, because VIX is also a pricing in the market. It causes your premium to go up. So if the VIX drops, the premium drops. And so even though there's a gain theoretically in the underlying index, the option really does not reward you. So that's the tricky part with the whole game.
Okay. And Rajesh, how are you seeing markets?
See,
Successful portfolio trade or portfolio, how would you plan it out?
I won't be able to recommend a stock or portfolio, but talking about the event, ideally for event, it is good to go with the lesser riskier bets, long straddle, but then not like you have to match the delta of the by the quantity. Say you bought 24,000, or 23,000 call put together, but just don't buy, one lot of each. You have to match the delta. So say it could be like, I'm just throwing a number, 1,200 call and 1,000 quantity put. So it will match the delta and then get into that. So ideally for an event, a big event like Lok Sabha result or RBI was not a small thing. It happens to be big on earlier. So long straddle, long triangle, but then not just one lot. You have to match the deltas. So it helps during the events. Option writers, we know we are heading into an event and which can get us 4 to 5% volatility in one single day. So I don't think that warrant any kind of unnecessary risk at this point of time. So, but anyway, we still have 3 months. We have a lot of expiries between now and then. So we can trade, in small time frames, and then when we actually, election things hots up, then we can get into directional related bets.
Okay, so on a lighter note, lastly, one question that like to ask all of you all is that one key tip that you will give to the retail investors in this volatile environment trading in this volatile environment, starting with Sudeep, one each.
See, what I feel is, Sujata, that risk management and position sizing would be the key factors that retail traders will need to keep in mind. There is always another day to trade. An opportunity would keep coming. One should not commit the entire capital in one single trade, and also not have ego while trading, because how can I go wrong? This question generally kills all the traders. So I feel not having ego, being very nimble-footed, and appropriate risk management as well as position sizing would be the key to survive the next 3 months volatility remaining. Remember that the markets are going to be there even after the elections, and they are going to give us a lot of opportunities. It is up to us how we manage our risk and how we manage our positions. That will bring us success in the coming few months.
Rohit.
Yeah, in addition to, position sizing on trade management, what I'll highlight is that when you get big swings in, both directions, it's possible many times that you end up with outsized gains. What's really important there is that you actually take some money off the table and move that into your investments, because what traders tend to do is then use those gains for the next trade and the next trade, and then somewhere in that volatility, it gets lost. So very important function is to always be booking gains from your trading portfolio, a certain percentage, whatever you define, and moving it into your investment portfolio.
And Rajesh.
Yeah, no hope trades. Don't take any trade and be on the hope that it will turn profitable to you. And then, of course, it's always advisable to keep your position check ahead of the events.
Sure. On that note, thank you so much, gentlemen, for joining me today and sharing such great insights. Thank you.
Thank you.